Hello and welcome to episode 385 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leach. Damien, what a week. It's been hectic. We've got budgets coming up. We've got rises to the Bank of England base rate. It's gone crazy.
It's been a really hectic week. So we knew this was coming, but it's unusual for all these things to be skewed right to the end of the week. So it means that we're incredibly busy on the last day of the week to do all of this stuff. So yeah, we had the base rate go up this week, which we're not covering on the podcast, but we have got articles that you can find on the Money to the Masses website. Of course, if you're a newsletter subscriber, you will see all the articles that we produce in the week and the best pieces from around the internet relating to your finances. So there'll be everything in there on how the base rate increase will impact you. So go to moneytothemasses.com/newsletter and you can sign up there. But as you say, Andy, it's been hectic because we've also had a mini budget which occurred this morning. So we are recording the podcast on Friday afternoon because Andy is going to do a summary of the key takeaways from that budget. And it was described as the biggest tax giveaway in 50 years. Well, yeah, tax giveaway if you are among the wealthy, that is. So that is what's coming up in the podcast. I might as well just say what's coming on after that, Andy. So you're doing that mini budget piece. Then I'm going to do an investment piece about the US dollar. It is one of the key things to look at in investment markets at the moment. So people often ask, what are the things you look at in the morning or during the month when you're reviewing markets? Well, the US dollar index is one of those things. It influences the movement of a lot of assets prices. So I'm going to explain why it's important and how you can use that within your investment portfolio. And then finally, I'm going to be talking about the impact of inflation on your income, and in particular in relation to pay rises. So it leads on from last week's piece, but it's a piece that you want to listen to, and it leads on to about asking for pay rises. But before we do that, Andy, I just want to read out two reviews that I promised we'd get to in the past couple of weeks. And the first one is JM Walters 87 left a great one saying, finally the one, which makes it sound very much like the Matrix. But the review goes on to say, this podcast is one that's finally convinced my wife to start investing. Andy and Damien have a brilliant way of taking quite complicated subjects and distilling them down into simple to understand nuggets of information. They also go beyond basic personal finance, an important topic, no doubt, but they go beyond and into investing amongst other more complicated but equally important subjects. A routine part of my week. I've still got 250 old episodes to get through, so their ability to not date the podcast is a great feature of how they present. That's a great review, and we've also got another one which I won't read through fully because it's very long, but it's from Matt in Bournemouth. Matt, thank you for that review. Its header is helping a beginner, and you can find a link to that actually on our socials because we do share some of our favourite reviews. Both of you do email damien@moneytothemasses.com and you will receive a Money to the Masses mug. And the last piece of admin before we get on with the show, Andy, I want to say to people, come and meet me because I've been asked to do an event on the 26th of October at 18 Finsbury Square, and PensionBee are doing a panel event talking about how you can plan for a happy retirement and also the cost of living crisis. So I'll be there with a few other people. Come to the event, say hello, make my day, and we can even have a chat afterwards. So a date for your diary. I will remind people in the future, but we'll also try and do a podcast meetup perhaps in the new year. Right, Andy, the mini budget.
Yeah, well, it wasn't so much a mini budget in the end. It was what I would probably describe as a maxi budget. Lots and lots going on. I mean, let's start with the headline grabbers. And these are the tax cuts that were expected. In fact, some of it was leaked the previous night, I think, to get a feel of what was going to happen to markets as these big announcements were being made. And actually, you'll probably share more on what it did to the markets immediately after the announcements in just a second. So National Insurance, the headlines are that has been cut from the 6th of November. To understand a bit more about that, it is a cut, but really it's just a reversal of what was put in place by the previous Chancellor, Rishi Sunak, in April of this year. There was a 1.25 percentage point increase added for what was called the Health and Social Care Levy. And we've barely had time to get used to that because it actually, although it was announced, it only actually came into place a couple of months back, but that's been scrapped now and reversed. And so what does that actually mean? Well, it means that if you earn under the personal allowance of $12,570, it means very little to you because you're not paying national insurance anyway. And of course, as you earn more, it will mean more to you in terms of savings. So just to give a few headline numbers. If you earn 20,000 a year, it's just under £100 a year savings, £93. If you earn £50,000 a year, it's just under £500 a year savings, 468 to be exact. And if you earn £100,000 annually, then it's around about £1,000 a year annually that it's going to save you. So there are savings there. But as I mentioned, all of that was expected and kind of released before it even happened. The interesting stuff, if you like, is the big news is income tax. The basic rate of income tax has been cut to 19% from 20%. I'll explain exactly what that is and what it means in a second. But the headline grabber is that the additional rate of tax, now that is the tax that's applied for people who earn over and above £150,000 a year, that's been abolished altogether, which means that any earnings over the higher rate of tax, which is £50,271, will only attract, it will attract a rate of 40% tax. So that 45% rate of tax has been abolished.
So usually what happens in these budgets is that you get some analysis afterwards where people try and work out who is the main beneficiary within society from the various things that are announced. Well, this budget was quite clear that it was actually just the benefit largely of the wealthy. So if you earn over £150,000, then your marginal tax rate, so when I say marginal, that means the highest tax rate you will pay on income is now 40% and no longer 45%. And don't forget that 40% rate is what people get charged as soon as they start earning over £50,000. So anything over 50,000 was already being charged at 40%. That is just continues indefinitely. I must caveat, I say £50,000 because it's easy to remember, but the actual number is £50,270. Now, I'm not being political, but it's just key to highlight who benefits and who doesn't, and to what degree.
Yeah, and on that point, so with the basic rate tax cut from 20 to 19%, it will make a difference. In fact, it's been reported that about 31 million people will be better off by an average of £170 a year based on that tax cut. So in real terms, if you earn £20,000 a year, it's going to save you about £74 a year in tax. If you earn £50,000 a year, it's going to be around about £375 a year in tax. And actually the max saving on that, because of the way the tax thresholds work, is £377. So, I mean, it's not to be sniffed at, but it's not as exciting as some may have hoped.
And the reason you say that max saving, because of the way the bands work, that you've got the 20% band that goes from the personal allowance we mentioned earlier up to that £50,270 mark, then obviously the 1% off of that band means that even if you earn above it, then you're still capped at the saving of £377. So that leads on to the benefit from the additional rate income tax.
Yeah, and this is why the government have come into a little bit of criticism, saying that these tax cuts were clearly done with the wealthy in mind, because cutting that 5% off on earnings over and above 150,000 makes a huge difference for very, very wealthy people. To give you an example, if you're lucky enough to earn £175,000 a year, straight away that's a saving of £1,250 a year in tax. If you're way up there in terms of the earnings league and earning £250,000 a year, that's £5,000 in your pocket. And those lucky enough to earn £500,000 a year, they're £17,500 a year better off. That's their ISA sorted.
And that all comes into effect from the 6th of April next year, doesn't it?
Correct.
So, of course, that if you combine it with the idea that the bankers' bonuses have obviously been uncapped, so the cap has been removed, then you can see the direction of travel and the purpose of this particular budget. So, again, we're not being political. We're just telling you what the intention is of this budget and who benefits. Now, stamp duty, Andy, this was meant to be the rabbit out of the hat for the budget, the one thing that people would get excited about. So, stamp duty.
Yeah, so basically what's happened is they've changed the thresholds. The thresholds used to be that there was no stamp duty payable on the first £125,000 of the property you're purchasing, £300,000 for first-time buyers. They've upped that now to £250,000 before you then start paying the stamp duty rates, and it's tiered as it goes up. You can go onto the website and Money to the Masses. We'll put a link to the article that explains how those stamp duty thresholds work, and everything that we're talking about right now is summarised in that article, so go and check that out. I mean, to summarise what that means is so long as you're purchasing a property over £250,000, it's going to save you £2,500 on stamp duty. And that's whether you're an existing buyer, a new buyer. So, good news for those.
And the best way to summarize it that Andy said earlier to me in the office is the 2% ban that was on the stamp duty threshold has effectively been removed. So all the other bans stay the same. They've just got rid of the 2% one. So you don't pay any stamp duty before £250,000 value of your property. But then beyond that, it then goes 5%, and then there's a 10% and a 12% band.
That's right. And just to mention as well, for first-time buyers, they would actually get additional relief because they're first-time buyers, which would mean that they wouldn't pay anything on the first 300,000. This increase from the threshold is actually being applied to those as well, which means that actually, if you're a first-time buyer from today with these new thresholds in place, you wouldn't pay any stamp duty on any property under the value of £425,000. So they've moved that band up £125,000. And in order to qualify for that extra relief as a first-time buyer, your property price does have to be under the value of £625,000. I suppose what they're thinking there is if you can afford a property over £625,000 and you're a first-time buyer, you probably don't need our stamp duty help.
And just to add to that, those changes are with immediate effect. And anecdotally, I've already heard of instances where sellers have immediately asked buyers who are due to complete for extra money for the purchase of their house, basically trying to take a bit more of that £2,500 that some people would be better off under the new rules. So moving on to corporation tax.
Yeah, just a quick one on that really. All of the planned increases that were due to happen in April 2023 announced under the previous Chancellor have been scrapped. So those businesses worried that corporation tax was going to raise up to 25%, no longer happening. It's going to remain at the 19% as it always was. Bankers' bonuses, we've touched on that already. But what that actually means is previously, bankers' bonuses were capped up to 200% of their annual salary. Well, that's been removed. And the reason that the Chancellor is saying that he wants to do that is because they want to create jobs here in this country. And finally, alcohol duty, effectively the planned increase to the alcohol duty again has been scrapped. So as we were.
So just to summarise, you can find all of that information in an article we'll put in the show notes of this podcast. And also you can find it on the article on the website, which you can find by clicking on the podcast hyperlink at the top of the site or searching in the search bar this particular episode. You can do that for any episode, don't forget. And just to mention, the stamp duty changes are permanent, well, at least until the next Chancellor or somebody changes things, but they're not temporary like we had during the pandemic. And all of this is in addition to the energy price guarantee that's been previously announced. So just to wrap this up finally, yes, there's been a lot of fallout from this budget politically, and you'll see in the headlines because it's obviously favouring certain sectors of society way more than others. And as I mentioned earlier, it's not normally so clear cut. Normally you end up digging beneath the details to find out some of the nuances which benefit certain areas. It's almost hidden, but this one is quite open. One thing that I would mention, EIS and VCT, so Enterprise Investment Schemes and Venture Capital Trust, which we've done a whole podcast episode on previously, they have been saved from the axe, so they still exist. So wealthy investors who get huge tax relief on those particular investments will be pleased as well. So aside from obviously the political fallout, the markets reacted violently to this mini budget. So we saw gilt yields go through the roof. So don't forget, a lot of this is going to be paid for by borrowing by the government, which they do via gilt, and the interest rates on those have rocketed. So the government's going to be charged even more to borrow money. Think of it like a company or a household that has been irresponsible with their finances or that are struggling, then they will get charged higher rates of interest. It's the same in international markets when it comes to lending. So that has rocketed. The pound has crashed. I mean, the last time I looked, we're in danger of breaking below $1.10, and so it's slumped, and that again is a vote of no confidence in the future of the UK economy. And of course the Bank of England is already predicted to have to raise interest rates to 5% by this time next year, and if they don't do that, then we can expect the pound to fall even further. So there's been a lot of stuff that's come out in the news this week, a lot of it not particularly great news for consumers, but as ever we're here to help you muddle through it and help you to prepare for the worst and hope for the best.
Okay, so let's move on with the rest of the podcast then. What's the next piece?
Okay, so the investing piece I want to focus on this week is in relation to the US dollar. Now, the US dollar is incredibly important, not only in world trade, but it is in investment markets. Now, if you've listened to any of the midweek market shows or the show that's now called, obviously, Damien's Market Update, you'll hear me talk about the importance of the dollar. And I've never really pulled it together on the Sunday podcast about explaining that importance and how you can use it. And I do appreciate not everybody listens to the update show on investment markets, but this is going to be more of a seminal piece that will be key, that I think a lot of people will keep referring back to, because if you understand the dollar and you get the direction of travel correct, then you get a lot of things right when it comes to investing. And if you almost front run it and are fortunate enough to do that, then you can actually make a lot of money from doing so. So what do we mean by the global reserve currency? Well, the broad definition is a strong currency widely used in international trade that a central bank is prepared to hold as part of its foreign exchange reserves. Now, in essence, it really means the dominant currency that is used around the world that will be exchanged for goods and services quite readily. So if you travel around the world, you will know that people will readily accept US dollars often in addition to their own local currency. And if it's a developing world, you will often find they want US dollars more than their own currency because of the importance of the US dollar when it comes to trade and buying goods and services around the world. And in very simple terms, the reserve currency is determined by who is the dominant superpower. So there was a really good video, which I'll link to in the show notes, by Ray Dalio, which was all about this concept and this idea about the reserve currency and how it's changed over time. But really, it's the dominant superpower around the world. Their currency is the reserve currency. So in the past, when we had different empires, including the British Empire, then the pound would have been that currency. But as things change and the US became the dominant power in the world, then the reserve currency is the US dollar. And there's questions over whether that's going to change in the future and which currency may become the future reserve currency around the world, or indeed whether it will be a digital currency. But that status as a reserve currency has huge importance, and it also influences different assets. So what I want people to do is, if you've got your phone or you're near a computer, look up the US dollar index. So on your stock app, it is actually denoted by the symbol DXY. So if you go and put that into your stock app on your phone, then you will find a chart that is illustrating the strength of the US dollar index. And what that is the measure of the strength of the dollar against a basket of foreign currencies. So that includes things like the euro and the pound, but also other currencies around the world. Of course, don't forget that currencies are relative, so they are stronger against other currencies. And so they can be strong against one currency while at the same time weakening against a different currency. What the US dollar index does is pull that together and give you a broad measure of the strength of the US dollar. Now, the strength of that dollar, as I mentioned, will influence a whole range of assets. Now, commodities are priced in dollars. You will read headlines about the price of a barrel of Brent crude, and it's denominated in dollars. So as the dollar's value varies, it starts to affect the supply and demand for that commodity. Also, if you think about it, if the dollar is strong, then it does start to hit the profit margins of US companies that make earnings overseas, because when you repatriate those earnings, then when you convert them to dollars, you'll buy less dollars if the dollar is strengthening. You may recall I talk about a similar thing in the UK. When the pound is strengthening against the dollar, then any earnings you have in dollar terms, when you repatriate that into pounds, you get less pounds for your buck, basically. And that makes their shares less attractive because their profitability falls. And so it starts to make share prices fall. So we get that in the US as well. But of course, because of the currency reserve nature of the dollar, it impacts lots of other markets too. So in Japan, for example, when the yen weakens against the dollar, then that tends to be good for their exporters, because obviously international trade buying goods in yen will be able to buy more, and so therefore it makes their products attractive. And generally speaking, what you will see is the Nikkei 225, which is the Japanese stock market, start to go up. Likewise, in the UK, when the dollar is stronger and therefore is stronger against the pound, then that tends to be supportive of the FTSE 100, because around about 70% of earnings in those companies actually come from abroad and are denominated in dollar terms. So again, when those dollar earnings are converted into pounds, which you are able to buy more of, because the currency is weakening against the dollar, then that makes those companies in the FTSE 100 attractive, so people will invest in them. So the US dollar, as you've started to work out, is important. I'll give you another example, emerging markets. So in emerging markets, when the dollar is strong, you tend to see flights of capital, so money moving out of emerging markets back towards the US because people don't have to take as much risk to get the return. The dollar looks attractive versus those other currencies, but also because a lot of companies in emerging markets may have assets held in their local currency, but they may have liabilities, i.e. loans that are denominated in dollars, then what you're getting there is the liabilities, so the loans they've got, when you convert them back into local currency terms, are actually increasing versus the assets the company has. So therefore, that is unattractive. So you get investors starting to sell out and move money back towards the US. Now, there is a bit more dynamic going on in the background as well, some nuances, but broadly speaking, when the dollar is strong, it is bad for emerging markets and emerging market assets, and also for Asian assets as well. So you start to see the dollar becomes quite important in a whole lot of things. Another one, a commodity again, but gold is often talked about separately from other commodities. When the dollar is strong, gold tends to fall. So what I want you to do now is look at that dollar index chart that I talked about, and I will include a chart in the show notes on the website. So go and find this show's episode on the Money to Masses website, because we'll put the chart in there. And you can find the episode by searching the episode number in the search bar on the top right of the website. And you will see I've drawn a chart that shows the US dollar versus the S&P 500, which is the main stock market in the US, over the course of 2022. And I've drawn big green and red arrows on there. And you will see the high negative correlation between the S&P 500 and the US dollar index. So whenever the dollar index fell in value over a sustained period of time, then the S&P 500 rallied. Conversely, when the dollar index rallied, the S&P 500 sold off. And we've seen that time and time again throughout 2022. And it is a pattern that we've seen repeat throughout history as well. Now, of course, on a given day, when the dollar index goes up, it doesn't always mean that other assets behave in the ways that I've described. But when there is a general trend that's happening over a period of time, then it does tend to follow that these assets do behave in relation to that dollar index. Now, there are lots of other moving parts in the world, so it's not the only factor that's moving markets. So you can have times where the asset behaves differently than expected. So you might have, for example, the dollar index go up, yet the FTSE 100 is tumbling heavily. Now, that could be because of other reasons that may be geopolitical, nuance to the UK. It can be a whole host of reasons, but generally speaking, we do see this pattern play out. And as a bit of fun, over the next week, what I want you to do, whenever you look at your stock app, look at the dollar index and see if it goes up. Then go and find the price of the FTSE 100 and the S&P 500 and compare the FTSE 100 to the FTSE All Share. So it's a much broader index, the FTSE All Share of UK equities. But the FTSE 100 is the one that has a lot of overseas exposure, particularly to US earnings. So that tends to be supported more and therefore outperforms the FTSE 250 or the FTSE All Share, for example, when the dollar index rallies, meaning that the pound weakens against the dollar. So it's never a one-in-one relationship, but it's very interesting to know. Also, when the dollar index rallies, have a look at how gold does. So you'll see the dollar index rally, you'll probably see gold start to underperform, and other commodities too. So that includes things like oil, like copper. And of course, now you can see why, if you get the dollar right and the direction of travel, you can then make pretty good assessments of the likely direction of a whole host of assets, whether it be emerging market assets and equities, whether it be UK equities, Japanese equities, US equities, even bonds as well, because don't forget that if interest rates are going up, it tends to push the US dollar up. It therefore means that yields start to go up on bonds, which means bonds tend to fall. So we're talking about US treasuries here in the context of the dollar. Again, it's never a perfect relationship, but you do get these movements. So what causes the dollar to move? Well, I just mentioned one there. For example, it could be that the US Federal Reserve is hell-bent on hiking interest rates. That's why the dollar index is hitting multi-year highs and is actually proving a headwind for a lot of assets, which includes US equities. Other reasons could be fear. So let's say when Putin started talking about possible or hinting at possible nuclear attacks, then you saw people rush to haven assets. Well, the biggest haven asset out there is actually the US dollar. So you can see that start to push up, which then has a knock-on effect. So you can see that it's important to keep an eye on what's going on with the dollar. And in 2022, because of that focus of central banks hiking interest rates because they're trying to quell inflation, the US dollar has risen to the fore and is becoming almost the number one factor to look at. If you look at anything on a given day, look at the US dollar, and then you'll know that US dollar up probably means commodities are down. It probably means there's a bit of support for the FTSE 100 over the FTSE 250, for example. It'll probably mean that Japanese equities may have got a bit of help from that currency kicker. But overall, if it's sustained, you're going to see a sell-off in some Asian equities, and you're also going to see in emerging market equities. If it keeps going up, you're probably going to see some action in bond markets, predominantly negative if the dollar goes up. But of course, you see the opposite. It all starts to reverse. Now, what is interesting is I mentioned there that the dollar isn't the only influencing factor what's going on in markets, and particularly in 2022. There's obviously geopolitics, there's a whole host of reasons. There are concerns about recession, there are concerns about company profitability, we've got other geopolitical issues, and there's so many things that are moving that just looking at one period of when the dollar went up and down and making judgment calls is difficult. So what I did for 80/20 investor members is think, how could you invest to take advantage of a dollar rally, the continuation of the dollar rise, or the collapse in the dollar? Because if we are getting to multi-year highs, there's obviously the chance that we could see some kind of reversal, as unlikely as that seems. Don't forget, things don't go up forever. So I want to explain to people how you can do that to take advantage of it. So what I did is I looked at the chart of the US dollar index. So look at it now on your phone, look at it on your internet browser. The best place I like to look at some of these charts is Yahoo Finance. So if you search US dollar index, Yahoo, you will find a chart that you can go in and explore. And again, if you click on the interactive chart, you can actually go and draw lines on, so do your own technical analysis, which is pretty neat, and it's all free. Now, I identified a bunch of periods in 2022 where the dollar had made some sizable moves in very short periods of time, typically 2 to 3 week periods. And why you want that is because you want quick, fast moves. So you want something that's going to happen quickly, because then when you see an asset also move quickly, you know it's going to be in response to that outsized move of that particular thing you're looking at, in this case, the US dollar index. And if you see that repeat over numerous occasions where you had similar sized moves in the same direction, then you know the reason that that asset moved was because of the US dollar index. So, for example, between the 12th of May and the 30th of May, the US dollar fell hard. Between the 30th of May and the 14th of June, it rallied hard. Then between the 27th of June, 2022 and the 14th of July, it rallied hard again. Between the 14th of July and the 1st of August, it tumbled. And then between the 11th of August and the 22nd of August, it rallied strongly. Now, those periods, if you look at the chart I compared to the S&P 500, coincided with the reversals and rallies and dips of that particular index. That's the S&P 500. And so you can see the influence that was there. So what I did as the research, I picked the 2 down periods and I looked at how funds, whatever asset class they invested in, whether it's bonds, whether it's equities, whether it's emerging markets or developed markets, and looked how they performed in those down periods. I also then looked at how they performed in the 3 up periods I mentioned. And if the dollar index was really what was driving things, and it was the overriding influencer, then what I would want to see, and on all the up periods, I would want to see a big directional move, either up or down for that particular asset, depending on that relationship with the US dollar index. And likewise, when we had the dollar index move in the opposite direction, I wanted to see a sizable move in that asset class in the other way. And by doing that and crunching the numbers through all the thousands of funds, I was able to come up with shortlists and see the ones that were most likely to benefit from a dollar rally and those most likely to benefit from when the dollar collapsed compared with their peers within the same sectors, for example. And you can do that. So you could go and look at a fund within your portfolio and look how it performed during those periods that I've mentioned, and you can see, right, this has a relationship with the dollar index that is positive, maybe. So when the dollar index moves up, this fund moves up, or it could be negative. So it can actually move in the opposite direction to the US dollar index, or it could have no correlation at all. And so then you will understand the influence the dollar has on your own portfolio. It is an important part of investing, understanding what goes on with the dollar, and lots of people overlook it. Like I said at the beginning, it's not the only influencing factor, but if you are only going to look at one in a given day or a given period, then this is probably a good nomination for the only indicator you might look at, certainly during 2022, but it is not unique to this year. So just to finish off the piece, to give people some more insight, not only have I told you now how you could go and see how the dollar impacts your portfolio, see how it impacts other assets, because make sure you compare that dollar index move to the other indices you might have on your stock market app, and then you learn that's how you find out these correlations and how markets work. But you could go and find new funds that you might want to try and play the rise in the dollar or a potential fall in the dollar. Now, these aren't recommendations. These are just to give you a steer. So you could maybe go and find these two funds on your platform and go, oh yeah, look, these are good examples. One fund that does well when the dollar rallies, but it does badly when the dollar falls, and a fund that does badly when the dollar rallies, but does well when the dollar falls. And so the first one is Baillie Gifford's Emerging Markets Growth Fund. Now, over those periods that I mentioned earlier, it's a global emerging markets fund. It fell typically in those couple of week periods when the dollar rallied, it would fell about 1.5%. But when the dollar slumped, it would rally 3.7%. That was the average over the periods I mentioned earlier. So it's a sizable difference. And that goes back to what I was saying about the relationship between emerging market assets and the dollar. You don't even have to know if the types of asset that the fund holds, because by analysing in this way and just comparing the correlations, then you find out all you need to know. So at the opposite end, a fund that did well when the dollar rallied was a fund like the CT Dollar Bond Fund, which is a global bond fund, and it did poorly when the dollar slumped. And that's because it tends to hold things like US Treasuries. So during the periods of dollar strength, it was up 2.5% broadly in those couple of week periods on average, but then fell almost 2% when the dollar slumped. So behaving in the complete opposite way to the fund I mentioned before. Again, they're not recommendations, but just examples of how by applying a bit of research, you can then understand what's going on in your portfolio and then take advantage of trends. And of course, if you want to see the full research piece that I did for 80/20 Investor, then you can, of course, take out a free 30-day trial where you can see the full list of all the funds and all of the analysis. Go to the Money to Masses homepage, and if you scroll down, you'll find a box that says about 80/20 Investor, and you can click on Learn More.
Okay, so moving on then, Damien, this kind of links back to what we were talking about last week in terms of inflation. You've got an interesting piece here on how people can actually use some information, use a calculator to work out the impact of inflation on their wages and any potential future pay rises they may be looking to get.
So the final piece I just want to do is a follow-up to a piece on the podcast last week, which we got some real positive feedback about, the personalised inflation number. So most people didn't really understand the difference between the official rate of inflation and their own one and how marked that could be. But of course, one thing that people do struggle with is understanding percentages. Now, if you're not one of those people, then that is obviously good for you. But for a lot of people, understanding that you want to try and get a pay rise that matches inflation or your own inflation rate is one thing. But then understanding that you probably might not get that inflation rate, and so you're going to get something that's much more in line with the national average of about 3.1%, in fact, then what does that mean in terms of how much worse off are you? And I want to bring that alive this week so people can go and have a play with a calculator. Now, the Office of National Statistics, I love that because I always struggle with that word, but the ONS have produced a really good calculator that provides a visualization of how much better and worse you'll be based on a pay rise. Now, I will link to the calculator in the show notes, and I'll also do it on the website for this particular episode. I won't read the URL out because it's a ridiculous one. I don't know why they didn't create something a little bit more easy to follow. But what the calculator does is you tell it how much you earn. It will then tell you what the average pay growth is, which is the 3.1% that I mentioned. And then it will tell you how much worse off you are or will be based upon inflation at the current official rate. Now, I say inflation, it's the CPIH number. If you remember, that's CPI plus housing costs, which is always marginally lower than the official CPI number you see on the news. But it will tell you how much in pounds and pence you'll be worse off in real terms each year. So how much less buying power you will have if you get an average pay rise, given where inflation is at a given moment in time. Now, they update the data behind this calculator all the time. So if you listen to this podcast in 2, 3, 4 years time, it is still relevant. You can still go in, have a play with the calculator and see where inflation is at the point you're listening, hopefully not double digit. And then you can see what kind of pay rise you would need to keep pace with inflation. So your buying power, you're no worse off than you are now. So your buying power is kept, because obviously don't forget, when I talk about buying power, that means that you can buy the same amount of goods and services as you have previously been doing so, because obviously inflation pushes up the price of goods and services that we buy. And if your wage doesn't go up, then you can buy less of them. But for people who listen to the podcast, I want to be able to give you a figure that you can play with in your head and do the mental mathematics. Now, if we go around, the average wage in the UK is broadly somewhere near £30,000 a year. To keep pace with inflation, so the CPIH number, you would need a pay rise of 8.6% based on the current figures that have just been released. Now, the reality is that most people won't get that. But if you were lucky enough to, then you would need your wage to go from £30,000 a year, this is your gross wage, to £32,580. So if you do get a pay rise and they tell you it in pounds and pence, you now know if you don't get to 32580, then you're going to be losing money in real terms. If you get an average pay rise, so a 3.1% pay rise, that means you will end up on £31,650 a year. So that's a pay increase of £1,650. But your earnings will actually be worth £930 less a year in real terms. So that's how much you'll be worse off compared to the same state of play this year, if we're talking about a pay rise next year. And so you can see the importance of inflation and why you need to protect yourself against it. Now, with pay consultations and pay reviews, it's quite difficult. Now, if you go back to episode 216 of this podcast, we'll put a link in the show notes, but you can search it on the Money to the Masses website. We did a whole section on how to negotiate a pay rise, and I gave tips and advice on how you could increase your chances of getting the pay rise that you need. Now, I can't guarantee you're going to get an inflation matching pay rise, because after all, we are going into a recession according to the Bank of England. So pay rises are likely to be harder to come by, because inevitably we are likely to see job losses. So I won't go through all of that, but there is also a line in there that I've used in the past to help secure pay rises that I suggest people listen to. And it's broadly to try and get the other person on the other side of the table to think like you. So how would they feel if they were in your shoes, given the hard work you've done and all the various different things that you've achieved for the company? You have to be very specific. I won't ruin it. Go and listen to the episode, because it's a much broader piece and I won't do it justice by rushing through it now. But based on those numbers that I gave you, what you need to do is multiply anything I said by your salary. So if you're lucky enough to be on 60,000 a year, then you double all the numbers that I mentioned. So you would want a pay rise of £5,160 to keep up with inflation as measured by the CPIH figure. But if you get a 3.1% pay rise, which is in line with the average growth in pay, then you'd have a £3,300 increase to your pay, but your earnings would be worth £1,860 less per year. So you can do the simple maths, depend on what you earn, to work out how much you are going to be worse off or better off in the future. And it's important to understand inflation in that pounds and pence, because it then leads on to other topics that I mentioned in the past about why it's important to try and own assets. So ultimately, you want to own assets that grow over time, because then they will grow in line with inflation. If you're only being paid via a wage, it's much more difficult to cope with inflation over the long term. So if you own assets, you own investments, then you can start taking advantage of inflation. So I hope people take away the importance of investing for inflation. So what I suggest people also do is listen to podcast episode 362, which is about investing for inflation, and also podcast 274 about how to increase your wealth and retire early. And that has an analogy to explain inflation and the impact it can have on your wealth. So again, they will be linked to in the show notes of this particular episode.
Okay, so that's it. We're done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com. We're in all the usual places. Do check out the socials, the YouTube channel, and of course the Money to the Masses community group on Facebook. It's facebook.com/groups/Money to the Masses. Anything to finally finish?
No, that's it. Just make sure you send in those reviews because you could win a Money to the Masses mug. And also, don't forget that date for your diary when I'm doing the panel event. It would be lovely to meet some listeners again because it's been years since we've been able to get out and about and do it. So make sure you come down to Central London on the
26th of October, Finsbury Square.
There you go, Andy. I was about to look it up because I've forgotten already. So it would be great to see you. So until next time.
Until next time.